Hey, what's up guys? My name is Daniel Lopez with Invest in You Finance, and today, if you guys are trying to buy a new home or looking into buying a new home, I just want to give you guys some value and hopefully this will help you out. I want to show you guys a strategy that I used when I first bought my primary residence back in 2016. So if you guys don't know about this, you can take a 401k loan from yourself to put that as a down payment on a home. You can also use it to basically do whatever you want with it. However, this is a loan and it's to yourself. So if you have a 401k, you could pull out, I think it's up to $50,000 of that money, and you're gonna pay it back to yourself through your employer, and they're gonna pull it out of your paycheck however you get paid. In my case, I was getting paid bi-weekly, so they would pull that money out every bi-weekly. So this is just something that I considered doing, and I did do when I first bought my home. I took out a 401k loan, and I have an example on the board. I wanted to show you guys the numbers that I went through and how I made this decision. If you guys are looking for a down payment on a home, a duplex, anything, this is just something you can do. And I want to show you guys the numbers so that way you guys can either agree with me or disagree with me. Put it in the comments, let me know what you guys think, and let's just go ahead and jump on the example. So in 2016, I bought my first home. It was a 3,675 square foot home in Texas. I had been looking on Zillow for like a year, just looking at properties. And this property, usually if I like a property, I'll just save it. And I saved it because it was really nice, it had potential, and it was at a decent price. Initially, they wanted $315,000 for this particular home. So I just saved it. I mean, I wasn't in a rush and I wasn't trying to make like an impulsive buy. So, I just kept watching it, and, month by month, the price kept dropping. It was at 315, then it went to 375, then it went to 250. I'm sorry, it went from 315 to 275 to 250. And once it went to 250, I was like, oh man, like this house has a lot of potential, and if I buy it at this price for 250, I'm already gonna have equity inside the home. It was a fixer-upper, and it just needed basically cosmetic work. It was a 1990s home that was stuck in like the pink phase where everything was pink and gold. So I knew that if I just put a little bit of money into it, it would be worth a lot more, which I would have equity. So if you're looking to buy a new home, I would definitely try and buy a home that you're gonna buy it and already have equity in the home. So at 3,675 square feet, the houses were typically going for like $100 a square foot, which is, I mean, look at all the equity. The equity that I had was like close to like $100,000 maybe. So I ended up, making an offer. They accepted the offer, and they basically took 240 because there was repairs that needed to be done. So they took the offer for 240,000. And, I just did some calculations because I was like, okay, how am I going to come up with a down payment? I don't want to pay PMI. I don't want to pay private mortgage insurance. I also don't want to come up with a big lump sum of money by having to sell my stocks, because all my money was tied up in my stock portfolio and all my investments. So I did not want to sell anything and then have to pay capital gains and ultimately just have to pay taxes on the money that I pulled out. So I thought, okay, what other ways can I come up with a down payment? So I considered, okay, I have a decent sized 401k. Why don't I look into pulling out a 401k loan? And my thinking was, okay, if I pull out a 401k loan, I'm basically shifting money from a 401k, which is an asset, to another asset, which is a home. So I'm not really losing money. It's just kind of going lateral. However, yes, my paycheck is going to be lower, but it's going to be going into the equity of my home. So I just did some calculations and I want to show you guys what I came up with. So option one is if I put 20% down, which is $48,000. So like I said, I think they'll lend you up to $50,000 on your 401k loan. So I was pretty close. I looked at how much they were going to charge me. So at $48,000, that would be the down payment. So let's get into the interest rate. In 2016, the interest rate was 3.5% interest rate, which was, I mean, great considering now interest rates are like 5 to 6%. And that was for a 30-year mortgage, fixed mortgage. So I was going to finance $192,000 and my payment was going to be $856 per month. For these calculations, I was not using property taxes, home insurance, and utilities and all that. I just wanted to do like a simple calculation, not considering those factors, just straight what I'm financing. So the total was going to be for 30 years, 360 payments. At the end of the 30 years, I would have paid $308,000 basically. And that's just for the loan. The total interest would be $116,000. Because I'm taking out my 401k loan, my 401k was going to charge me 5%. And that 5% goes back into your own account. So I pulled out the $48,000. I put that as a down payment on the house. And they're going to charge me a 5% interest, which is okay. It's going to go back into my 401k either way. The payment on the 401k is $903 per month, but I was getting paid bi-weekly, so there was 26 paychecks a year. They were going to pull out $416 per paycheck. And that's something that you can't pay it like on the side. Basically, if you're going to take out a 401k loan from your work, they're going to pull it straight from your paycheck to make sure that you pay. So $416 was coming out of my paycheck, and the total number of payments was going to be, for 5 years, it was going to be $54,000 is how much the total loan was going to cost me. And the interest was $6,200 basically. So that was just going to go back into my 401k. I was going to pay myself back $54,000 over the 5-year period. And the reason I wanted to put 20% down was to avoid paying the PMI, which PMI, it does not go into your equity, and you have to keep paying until you have 20% equity. So I was trying to avoid PMI, and I was trying to avoid pulling out money from the stock market to put my down payment. So the payment was going to be $856 for the $192,000 I was financing right here. Plus, I had to pay the $900 to my 401k. So if you add the 900 plus the 856, you're gonna get 1759. So I was gonna have to pay $1,759 per month for 5 years, and then once I paid that for 5 years, my payment would drop back to the $856 per month because I paid my 401k back to myself. So, I was okay with this because I was gonna save ultimately PMI, and I was gonna immediately have, a lot of equity, 20% equity, plus the house was worth a lot more. So, that's just what I wanted to do. On the other case, I wanted to consider, okay, what if option 2, I put 5% down? Okay, where was I gonna get that 5%? Well, I was gonna have to either save up to the 5%, which is $12,000, or, just wait. Like if I wanted to buy that house, I was gonna have to wait until I accumulated $12,000 in my checking account, ready to put that as a down payment for 5% down. And the interest rate was gonna be 3.5% for 30 years. That means that I was gonna finance $228,000 because I did not have 20% down for the payment. I was gonna have to pay private mortgage insurance. Typically, I mean, I've seen on the internet, it's like 0.4% all the way up to 2%. So I just wanted to do an average. It was gonna be like 1%. So 1% is about $190 per month in PMI, private mortgage insurance. I ran a calculation and I figured it was gonna take me 6 years of paying PMI before I can stop paying PMI and I would have 20% equity. So for 6 years, I was gonna have to pay the $190,000 per month. That $190,000 per month was gonna come out to $13,680 for 6 years. So this $13,000 was gonna be just, not towards my equity, not towards anything, just, given to the bank. So I was also gonna have to come up with the $12,000 on my own, however I was gonna come up with that. So total, the payment, if I put 5% down, the $12,000 for 30 years, the payment was gonna be $1,016. But because I have to pay private mortgage insurance, it's gonna be $190 added to the $1,016. So that's gonna give me a total of, my payment's gonna be basically $1,200. And it would be $1,200 for 6 years until I paid down the PMI. Then it would just go back to $1,000. So total, just from my payments for 30 years, this house is gonna cost me $366,000. And then the total interest is gonna be $138,000 in interest. So if we add the $12,000 that I have to come up with for a down payment, plus what the house is gonna cost me after 30 years, $366,000, plus the PMI that I lost because I didn't put 20% down, you come up with $391,000 and some change. If you subtract how much it's gonna cost you if you put the 20% down, so you subtract, the $308,000, you're gonna come up with $83,000 and 744. Sorry, that's a 3. So basically, you save $83,000 by coming up with the 20% on your down payment. Now, if you have $48,000 sitting in the bank, you don't have to take a 401k loan. You could just put that $48,000 down and, the house total is gonna cost you $308,000. So when I saw that if I only put 5% down, I was gonna lose $83,000 over 30 years, I decided ultimately I would rather take the loan out from myself because like I said, I'm shifting from the 401k, I'm shifting that money, which is an asset, to another asset. And this asset is a 3,675 square foot home, which fixed up, it's selling at $100 per square feet. So fixed up, that's $3,607, $1,000. That's how much the house is worth once it's, fixed up. So from this $83,000, I was gonna basically fix it up, and I was hoping not to use, all that money that I saved, but, I'm going to have to put in a little bit of money. So I ended up going with option one, and I did that, and I basically, had to pay $416 for my paycheck every bi-weekly. And the reason I chose option one is because, remember, I'm thinking I'm only going to work for 10 years. When you're thinking about becoming financially independent, quitting your job and living off of the pool of money that you've saved up, what you think about is, okay, I'm going to try and bring down all my expenses. So I'm trying to bring down my expenses so that way I can basically not have a home payment, sooner. And my expense was going to be $856 per month. However, I was going to have to pay $416 every bi-weekly, but I had to do that for 5 years. So initially, for 5 years, I was going to have to pay $1,759. That is a bigger monthly payment. But after the 5 years, when I was going to become financially free, quit my job, and stop working, my payment was going to be more manageable at, $856 per month compared to $1,000 if I did the 5% down, and I wouldn't have, the equity in there. So that's, that was my thinking. And please, guys, if you have any comments or questions, or you disagree with me, put it in the comments below. Let me know what you think and what your opinion is. Also, guys, please like and subscribe. I appreciate you guys watching the channel. I'm trying to bring these videos up as fast as I can, hopefully bring you guys some value. These are just the steps that I took to become financially independent. What happened in this story with my home was in 2016, I bought this house, and in 2018 or 19, I can't remember, I ended up just paying the house off. I paid the house off because what happened was I had some stocks that had really gone up in value, and I was just getting tired of the payment. Like I said, when you want to become financially independent, you want to get rid of all your payments. So that way, every month you're not having to put a lot of the money that you saved into these things. So I said, okay, I'm just going to sell some stocks. Yes, I'm going to have to take a hit. I'm going to have to pay taxes. I can't remember the year, but I paid on top of the money that I took out from my taxes from work, I still had to pay on top of that $17,000 of my own money because of the capital gains when I paid off my house. It was a big chunk of change. I financed $192,000. 2 years into it, I still owed, close to that. So I just said, you know what, I'm tired of this house payment. I'm just going to sell some of my stocks from my individual stock account. And same thing, I'm going to transfer the money, a lateral move from individual stock account to home equity. It's going to cost me, 10% long-term capital gains or 15%. Can't remember which tax bracket I was at the year, but I was okay with that because then that meant that, okay, I don't have to worry about my house payment when I quit my job and I'm financially independent. My house will be paid off and my expenses will be really low, because when you become financially independent, you want to have low expenses. And that was my thinking. I had the money in my stock account. I didn't know how long the stock market was going to be, at all-time highs. I just wanted to cash out and take that money and pay off the house. So I ended up paying the house off. And fast forward from 2018, 2021, April 2021. before I moved to like a small assignment with my wife. She does travel nursing. We moved to Hawaii, but before that, we sold the house for $489,000, and that was 2021. So this number shot up, and I am forever grateful that I was able to sell the house for that price. And ultimately, because it was my primary residence, I avoided paying capital gains tax, and it was a great feeling to sell the house for that much money. The house was meant to be like my dream home, our dream home. It was huge. It had 5 bedrooms. It was amazing, on top of the mountain with an amazing 360 view. But what you have to consider when you buy a home that a lot of people won't tell you about is the hidden costs. Your property taxes. Property taxes on this house when I bought it were close to $9,000 every year. So that's what's gonna happen when you buy an expensive home in Texas. Texas has high property taxes. They have houses that are, decently priced, but where they get you is the property taxes. So I was like, this house is amazing. It's my dream house, whatever, but do I want to pay? Because the house was paid off in 2018. However, in the calculation, I don't show it, but you're gonna pay property taxes. So property taxes per month are $750 per month. $750 forever, for the rest of your life, no matter what. And guess what? That number just keeps going up every year. Every year you get your property tax statement and it says, oh, your home increased in value, you got to pay more property tax money. So although this was a great, amazing dream home, I decided that I would rather buy a more manageable home that would not have as high property taxes. I mean, I grew up in a 3-bedroom, 2-bath home. It was amazing, and I don't think that buying a home that's this big was worth it for me, because I'm gonna be financially independent, and like I said, I'm trying to bring down my costs, because I'm saving up all this money to have a pool of money so I can live off of it, so I don't have to work. So the choice was to sell the home and basically later on in the future buy another home, but it wasn't going to be at this price. It was going to be at a lower price, because I just would rather have the big payday. And because I lived there for 5 years, I wasn't gonna pay any taxes on that. Anyways, guys, I hope this brings you value. Think about it. If you're trying to buy a home, you could pull out a 401k loan, pay it back to yourself, do a lateral move, and you're going to have to budget and make sure that that you can cover the 401k payment as well, because your check's gonna be basically a lot smaller because you have to make that payment. It's gonna be worth it though, because in the end, you save $83,000. But I appreciate you guys watching. Please like, please subscribe. If you gained any value, please comment below. Let me know what you guys think. Did I make the right move? Did I make the wrong move? What would you have done? I wanted to do another example, like option 3 okay? If I went with option two, and I just invested X amount of money, how much would I have on the side? But that'll be for another video. I just wanted to do this video to show you guys how I bought my first home, how I put 20% down, and this is just an option to consider. I have another video out there where I actually show the calculations a lot better and show some websites that can show you guys how to do this. At the very end, it'll be one of the videos you can choose, and it's how to put 20% down, avoid PMI, using your 401k. Thanks guys, I appreciate it. Take care, have a great year, and please like and subscribe. I'll catch you in the next one.